Welcome back to Optimum Live, episode 18. The title is Financial Considerations for Your Buy-to-Let Property, Company or Personal. The intention of this episode is to demystify a big decision for landlords, whether to buy a rental property through a company or in their own name. Frequently asked question. Apparently, I'm being led to believe it's even more popular these days to try and work out the options. And I'll be delighted that we're going to have Michael Blaken here that will take us through all the things that we may think about when we're trying to make this decision. So, as I say, Michael Blaken.
Hello, Chris.
Sir.
How you doing, all right?
Yeah, I'm good, thank you. I have a feeling that this was one of those ones going, yeah, we need to cover this, but oh my goodness, this is a headache. It seems a lot to it.
I think I wrote a similar email 3 times last week, and it's like, it seems a good topic to bring up.
Oh, let's start right at the beginning. For anybody who maybe isn't sure, can you briefly, did you clock that word, Mike?
Briefly, yeah.
Explain what we mean by, I mean, it sounds fairly obvious, but renting a property through a company versus in your own name.
Absolutely. So this isn't for renting for yourself to live in. This is for buying an investment opportunity and renting it out to Mr. Smith, let's say, and earning a return and hopefully a capital appreciation as well on the value of the house over a period of time. Yeah. Some people use them as their unofficial pension funds, going, we'll get some rentals so that then I'll live off the rental income in my retirement.
Yeah.
So there's lots of different angles of people looking at it. Some of them look at them as a quick bit of income in the short term if they see that there's a property they can make some money on as well.
Is it, I know that we're taking this in the angle of residential property, but I've sort of also seen people on commercial property where they potentially decide to do it as a pension.
Yeah, that's right.
So
typically, a pension fund cannot own a residential house or dwelling.
Yeah.
So you can't, nothing that can be lived in. It's just complete break of the rules of a pension scheme. So when you're working with your pension advisors and trustees and stuff like that, they'll be like, no, you can't do that. The tax charge is horrible. So it's just a complete flat no, it doesn't happen. But whereas a commercial property, if you've got a business manufacturing, their pension fund in theory could purchase the factory, the warehouse, and own it in the pension fund, and then the company rents it through to their pension fund. So it's a nice way of owner managed businesses, owners, shareholders, directors to use their own pension funds to benefit their business essentially by getting that commercial property, whereas typically it's tied up in standard investments in there. And
I know we have gone off topic of this particular one, but yeah, that is normally done the other way, isn't it? To benefit the business, so that the company can have something, but it's not suddenly got a whole assets out there or something like that.
Yeah,
that makes sense. Right, I'll get us back on track because I went off on a tangent with that.
It's good to know the difference.
It is, absolutely. So in other words, this is that, even if I as an individual go, do you know what? I want to I see a house up for auction or whatever it might be and go, I want to get that and do it up a little bit. I think I fancy myself as doer-upperer.
Yeah.
That's what my wife calls me. And I want to do it and then rent it out.
Yep.
I do have a choice of whether I personally go and find the money or whether I go, actually, do you know what? Would it be in my business, Visual PR Productions now? It would have to be a separate business.
Typically, it's a lot cleaner to be in a new, some people use the phrase SPV, special purpose vehicle, essentially a new limited company.
Okay.
Right? So it's typically done there. You have your trade over here, and that one's stuck, it is in its own little box over there. So so again, it's another company, but there's naturally, if we're considering, we talked before about the downsides of having extra companies and stuff, potentially. But naturally, if we're thinking it as an idea, there's got to be quite a few advantages, which there are. And we can go into those as we go along. But yeah, it is looking at where's best. There's some short-term, long-term changes of tax rates, that need to be considered. Okay. Depending on which one you go down.
Hence, I now completely understand why we're doing an episode on this, because I think it's probably over dramatic to call it a minefield, but there are a lot of things that need to be looked at and considered.
And it's not just tax things. So naturally we get asked, what's the tax changes and what's the tax consequence? But Rob uses like the phrase of don't let the tax tail wag the dog.
Yeah.
But it is that. So people go, oh, which is the best for tax? But there's so many more things to consider that affect the decision. And again, it comes potentially down to whether you're looking for a short-term gain or a long-term gain, because one might be more advantageous depending on which way round you go.
And would another thing that would impact this is whether I've just gone, oh, there's a house that's at a decent value and I think I can do something with it, or whether I'm going to do multiple properties.
Yeah. Yeah. So it is. And again, so quite often when someone will phone up and go, what am I doing? And I go, hang on a minute, 20 questions first. We've got to find out what the motive is here. And like I say, the ones who are trying to build a big portfolio up, they tend to fall down the line of a limited company, because of various reasons. So, and we'll go through those, and hopefully we can help sort of iron out some of those queries, or at least then when a client does phone up, they go, oh, actually, we've looking through, I think this because of this, and this. Do you agree? And we'll still deal with those calls and emails and stuff. It's just to try and help to get the clients to understand why we're asking all these questions, rather than it just being, oh, here he goes again, he's asking a load of questions. It's actually, this is the knock-on effect of that one. This is the knock-on effect of that answer.
Yeah, absolutely. And just so everybody knows, we're going to be covering things like stamp duty, interest rate charge, tax of interest rate, and exit, capital gains tax as well. So when you come to sell it, all of those sorts of things. How much more popular is it becoming for landlords to use a company structure instead of personally, and why? So
it pushed on quite a few years ago, probably 5 years ago, when the tax regime for individuals changed on rental properties. So something was brought in called, you only get basic tax relief on your mortgage interest. Yeah. So so the basic principle for an individual is rental income less cost, whether that's management fees, repair costs, if you had a bit of empty property, council tax, kind of those costs, right, will come in, and then you would times that will get added to your other income. So whether you got employed income, dividend income and bits, and then get charged at your applicable tax rate. So that could be 40% if you're a higher rate taxpayer.
Yep.
And then however much you paid in mortgage interest, that's not the repayments, that's just the interest. So if you're on a capital repayment, most aren't, but if you were, you could only have the interest element.
Okay.
And it's that times 20%, your basic rate tax relief. So in theory, you could have £1 of rental income charged at 40p. Yeah. So 40%, 40 pence tax, £1 of mortgage interest. So in theory, you've made no money, because you had £1 income and £1 out, but you only get 20p saving on your interest rate. So therefore you charge 40p.
Yeah.
You take off the 20p for the interest rate. You've still got a tax charge of 20p, even though you made no money. Oh. Right. And that's what changed. So because of that change, that made people look at limited companies, because you don't have that rule in a limited company. So £1 in, £1 out, zero, no tax bill in those circumstances. So lately, with the interest rates and everything as they are, we're seeing a lot of situations where individuals actually lose money in the short term for having a rental property by the time they take into account how much they're paying on the rental, less they're paying out for cash out for the interest, cash out for a tax bill, because they created a tax bill because of those rules.
Yeah.
So that period of time was driving people more into a limited company.
Okay.
So your question that you asked 5 minutes ago.
So that's the reason why it's become more and more popular.
Yeah.
But it's still a discussion and something that still needs to be looked at. It isn't automatically the best way to
absolutely not. There's a whole, like I say, I use the phrase 20 questions. Yeah, there's probably loads of different circumstances that pushes people down like which way. And it could be how long they expect to keep them, what they want to do. Do they need to live off the rental income, or do they reinvest in it? Because if you need to live off of it and actually have it to top up your income, then individually, whilst you might have this extra tax charge in the short term if you've got mortgage interest and you happen to be a higher rate taxpayer, but once you've made that profit and paid the tax, that's you.
Yeah.
Whereas in a company, we pay 25% corporation tax on the profit. Then you're going to pay dividend tax to take it out.
Yep.
So then you might end up paying a double tax charge here to live on. Yeah. So these are things that we start to consider. We start having to weigh up the pros and cons against which approach.
Okay. Hence the 20 questions when someone comes to speak to you.
Because, so if you think of that scenario, if over here you're paying largely 40% tax, but in a limited company you might only pay 25%. If you're looking to reinvest, to put more deposits down to buy more properties to build a portfolio, naturally you're going to have more properties quicker or more deposits quicker with a limited company, because you're only being charged 25% on the full lot, not 40%, and not getting all the tax relief off the interest. Yeah. Right. So this one could speed up the returns into a limited into deposits with a limited company.
Got you.
So again, if sometimes people come to me and say, look, I'm buying one now, I want to buy one next year. And then as soon as I can, I want to buy 3, 4, 5, and I want to get to 10 by the time I'm retired. Right.
Sure.
That one, we'll start putting the needle over here going, we need to look at a limited company because of that cycle. But then that'll be question 1, or that'll be scenario 1, like on a tree diagram. Right, we're going off that direction, we're heading there. Yeah. But then it might be, yes, but then I want to sell them quickly or do this or do that. And then it's like, oh, hang on, we come back over here.
Yeah. So hence there is that, what's your goal? I mean, is it short term? Is it long term?
Yeah.
And that does make sense. Can it change? And that was one thing that's coming to my mind as you're explaining that, is that I sit there and go, no, I don't know yet. I've not done this before, so I'm just thinking 1. And then you suddenly go, oh, actually, I quite like this. And then you start adding more and more. Can we change?
You would change the new ones.
Fine.
Not the existing ones.
Yeah.
Because the existing ones, you're gonna, typically, most cases, you're going to pay stamp duty again for the limited company to buy it off you personally, or you to buy it back out of the limited company. And at that point, you'll crystallize a gain for capital gains. So if you bought it for 350 and you sell it, the market rate is 375, you got 25 grand a gain. So you got, capital gains tax bill off of that. So what it speeds up. So typically, someone's got to have a really good reason for wanting to move it from you to you via a limited company, because you're creating these tax bills. And depending on circumstances, there are people out there that tell you could do it without all those jumps and stuff. Right?
Yeah.
Still a little dubious over those ones. And again, circumstances, they apply more to ones who've got multiple 10, 15, something that looks like more of a full-time job going on, rather than one that you have an estate agent on. And all you do is go, oh yeah, 950 came in last month, lovely.
Yeah.
Right. So, but again, that's one area we don't want to go down into this one, but that is some consideration.
Yeah, no, that makes sense. And of course, we've still got, which I assume still has to have math done on it, is that my bone of contention, the associated businesses. And I'm not going to take us fully down that rabbit hole.
We've got an episode on that one.
We have. Go back and watch a previous episode. But in its shortest sense is that what's the threshold before you got 50K profit?
Yep.
But if I start up another business, it's now 25K in each.
Yep.
And if I had a third, it's actually, split between the 3, et cetera. Yeah. And so that has to come into the equation. But it sounds like I don't have a choice though. I couldn't put it in this vehicle to have just the one company.
You would, yeah. So what tends to be the driver of that one is the mortgage company. So, because a mortgage company doesn't, it's more risky to a mortgage company to have a trade that could go insolvent. Yeah. With an asset that they've got a charge on. Now they've always got a charge, so it's messier.
Whereas if it's exclusively the property, they know they've always got that.
This is the cardboard box that has the limited company in, and that's what they have the charge on. For them, it ticks a lot more boxes. So again, whilst in theory it could work, the mortgage company might block it. And at the end of the day, when you're borrowing someone else's money, you've got to play by their rules most of the time.
Fine. Okay. Right. Let's pick into these a little bit more. Let's start with stamp duty.
Stamp duty. Yeah.
Are there different stamp duty implications whether you're doing it company or personal?
No, so long on the basis that you already own your own home as an individual. So you've already got one, and then you're buying an additional property, right? So on an additional property, whatever the stamp duty rates are, you got an extra 5% charge on top.
Even if it's buy to let?
Buy to let, yeah. Okay. So in theory, there's no difference. It's a very rare circumstance where you'll have someone who doesn't own their own home and they're buying a rental property. Yeah. Right. So let's ignore that scenario because that is very, very rare. So yes, there is additional stamp duty. So we can have a look at an example, but like on a 300 grand house, I think earlier it was about 20 grand the stamp duty that you'd have to pay. So this one. That's it. So you can go onto the Gov website and you can go in stamp duty calculator and it comes up with this screen. So if we were to do a, generic purchase, so let's say a freehold purchase, and then it comes up, are you buying as a non-residential? So, transaction. So residential, because we're looking at, a house that you would live in. Yeah. Effective date, let's put the 30th of June or 31st of July. Yeah. Cause it's got it saved there. Lovely. There we are. Lovely. Perfect. And then, so this is if you were overseas buying into the UK. So we're no.
UK. Yeah. The double negative. No, we're not a non-UK. What?
Yeah. And then this is where it puts you down, are you a limited company or individual? However, the outcome. So if we'll go down the individual route because you haven't seen this bit. And this all talks about whether you've got an additional property already.
I see.
So if we go yes.
So yes as an individual.
And then will result in 2 or more properties. So yes, because in this scenario, we've got our own one and we're adding another one. So yes. Is it replacing your main residence, this new one? No, because we're going to keep our main one, right? Okay. So then we put, 300,000 in there. And if my magic, scroll to the bottom, just check the answers that you're happy, which I am. There we are, £20,000 for buying that £300,000 house. Okay, so
payable up front.
Up front on the day when you hand over the rest of the money.
Wow.
Okay, so and if you had gone down the limited company route, still would have been 20 grand.
It was, yeah, because when we spoke about this before and you showed me the example, it was still.
We went down. That's it. So that again, that's a consideration that needs to be done when looking at a rental property, because so most scenarios you're going to have a mortgage. Okay, we won't go down the mortgage rates yet, but. So typically, most scenarios, you've got about a 70% mortgage, a 30% deposit. Yep. So you work with your brokers on that. So, but when someone's looking at being able to fund one, you've got to come up with the 30% deposit, stamp duty, legal fees and searches. That's your contribution at the start. So a £300,000 house. Okay. So if it's say 25% deposit, just to keep the maths nice. That's 75 grand plus 20 grand stamp duty, 95 grand searches, maybe more broker fee, mortgage fee. You might just round it up with a nice 5 grand. That's 100 grand to buy a 300 grand house. So when people think of the headlines, you need a 25 or 30% deposit, 100 grand on a 300 grand purchase is actually a third. Yeah. Because when you add the other things into it. So again, where's that money coming from? Has it got to come from your trading company? Have you got to pull some extra? Have you then got an extra dividend tax over there because you're already taking 50 grand, but you need to take 30 out to pay for the deposit? Yeah. Right. There's those kind of scenarios that you've got to consider. That all comes into it, whether it's worthwhile or not, because that's your short-term costs. So if you've got all that cost going out now, what's the benefit? How much am I going to gain in the long term? And so it's the crystal ball of how much house prices are going to rocket or not and build. Are they going to build more than having cash in the bank, save for savings or whatever your financial advisor.
What's the rental rate on it? What's the
it.
likelihood of it being empty at all?
Yeah.
All those kind of things, I guess.
Percentage of like, what's the chances of the tenant smashing up the kitchen and you don't get it all covered on insurance? Like, we see all these examples happening time and time again with landlords. And so they've got to be factored in. It's rare that you get someone like that, but there are always those costs. So then you go, well, actually I've got a tenant in, it's doing quite nice. But is it okay? Now, you've got obviously other clients that do the property management bits for you, that can look after all that and keep things running sweet for you. Yeah. So it is just, they can mitigate some of those potential costs if you've got bad tenants in there and stuff. And that's what the estate agent's there for, is to try and vet the clients and stuff. So again, all those factors need to be pulled in to be understood to see how good an investment it is for yourself.
Makes sense. You're talking about these expenses, and I don't believe we're going down another rabbit, Warren, of the mortgage side of thing, because that's probably a whole other topic in itself. I might be wrong, and you might take us down that. Oh yeah, we do talk about interest rates, but I was very briefly going to touch on, you're telling me that I would go, and I use myself as an example, not that I have any intention of doing this, but I've got Visual PR Productions, we do video content, blah, 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 and, do you know what, I'm going to get involved in this, and I might have, 2, 3, 4, whatever properties that I already have got my eye on. You're now saying is that no, it would be a separate company.
Yep.
How would I be granted a mortgage when the mortgage company is going to go, you've just set this business up?
At the end of the day, you as a director are personally guaranteeing the payments. So typically what happens, so on the other side of the business with Ian on the legal side, he will need to do what we call ILMs, which is independent legal advice. So they would sit with the director who is signing up personally to make the payments. So it kind of then, whether it's in a limited company or not, puts you on the same footing as an individual buying a rental, because you personally are committing to those rental payments, even if it's there. So
that gives them the confidence. Can that then change? And I apologise. I know I always apologise for asking silly questions, but hopefully the idea is just what some of your viewers might be thinking. But equally, I'm conscious I take us down rabbit, Warren, so I hope I'm not going too far down a wrong direction here. But can that then change, that suddenly says, do you know what? I don't need me to be a personal guarantor, a guarantee?
No, I don't. I think it's rare.
Because the company's making enough money now that says, actually remove me from this equation now.
But why would a mortgage company agree to it?
Because because the company's making enough money.
But they're reducing their security by taking you off. So therefore putting their investment risk portfolio up a little bit.
So that's not something that would ever change?
I don't think so.
What about if...
again, it probably is mortgage specific. Different companies might have different requirements, but typically with the one, so like we get clients who go off and do that, and then they'll need to get independent legal advice. So they come in, book a meeting with Ian. So quite a lot of the time it is, it's happening.
Okay. And I guess in my mind, I was also there going, okay, but Visual PR Productions has a cash pool that says, you know what, we're going to put that, I don't know, let's say your 100 grand that you said earlier, that 100 grand is going to be put straight in here. I have no idea whether that's even doable.
Yep.
And that then the mortgage company turn around and go, oh, all right then, do you know what?
And that's it. So they kind of, in these scenarios, have a double security, because they got the fact that you've put in a big old deposit. So therefore, I think in their eyes, they would look at it with common sense and go, they could fire sell it and still get their money back.
Absolutely.
Right? And then if not, they're still going to get you to guarantee making sure the mortgage payment. So like for them, they're sweet. Right.
Okay.
And at the end of the day, whether you agree with it or not, my view on the common sense side of things is it's their money. They don't have to lend it to you.
For sure.
They don't make money, granted, if they don't lend it.
Yeah.
But they're going to lend it in the most secure way that they can possibly be.
Because make money on it. Absolutely.
And so like a lot of scenarios will come down to, what's your mortgage company saying? What are they allowing you to do? It might be good on paper, but if you don't do it, if you can't follow by their rules, you can't have their money.
Yeah, which is understandable. Okay, that makes sense.
Your brokers,
so they would be looking whether I could afford it then. That's what I would then need.
Yeah, a little bit, yeah. I don't know. I don't know how far down that road they go, whether they're checking but it largely is done on what rentals are done, what you achieve when I work with the brokers and stuff, that is looking at what the rental payments are going to do. Will that more than cover?
Yeah, of course. Yeah, that makes sense. With the how much risk are we taking because it might be empty for 2 months in a year or whatever they choose to do. Okay, fine. So it doesn't affect how much you pay up front, whether we go personal or company.
No, it's the subsequent knock on of the tax to do so. So if you need to pull that deposit from your company, you got your, to buy it individually, you pulled extra dividends from your company. So you've got your extra income tax. Now, if you've got money sat in a limited company, quite often you could do an intercompany loan to another company to enable them to purchase a deposit. Some mortgage companies still get, their heads around that and get a little confused with the situation. So again, it doesn't always work, but in theory, one company can loan another company money, and therefore it would save you pulling out and paying dividend tax.
Got you. Fine. Okay. Next one, and I said we weren't, and then realised we were, mortgage interest being a big consideration. How is mortgage interest tax relief, how does it work differently, for companies over individuals? Apologies if I butchered that question.
There's two bits, and there's one, the things to consider is, so on the mortgage rates, and when last worked on one with a client and their broker, it was about 0.7% higher than if you were buying your own home to live in and buying in your own names a rental property. It was like 0.7% higher mortgage rate. Okay, so that's some financial costs to consider each year, and then a limited company would be a bit more again. Right, so again, this is where they have their cake and eat it. Again, they've got more security and they're charging a bit more for it. So again, those considerations in your own name, in the limited company name, you're going to pay a little bit more mortgage rates typically in a limited company.
Okay.
Speak to your broker, see what you can get. You can run scenarios past them to see what it comes out with, but that is typically what we're seeing when the client sends through their mortgage statements for the year. They'll lose it a little bit higher on a limited company. Okay.
Does that
tax? Yeah. So then like you say, the next bit is the tax. So that's that.
It, yeah.
And that's the bit at the start where we talk about how it works. So so on an individual, you total up your mortgage income.
Yeah.
Sorry, I use that interchangeably, the wrong word. Your rental income.
Yeah.
Less any estate agent fees, including the VAT, because you're not going to be VAT registered for this. We're not going to go why, but you're not. Okay. As an individual, right?
Fair enough.
Less your gas safety certificates, less your insurance, your landlord's insurance. Maybe less the fee to do your tax return for the rental property, less your repair costs if you had to replace something like, the carpets need replacing, the walls need redecorating, painting.
The boiler's gone back.
Yeah, the fence needs replacing and repairing. So those costs, you get to them, like your rental profit.
Yeah.
Right. We've not talked about mortgage coming off yet. And that's right. So this is just that. You add that on to whether you got employment income, bank interest income, dividend income. So on your this all forms part of your tax return. It adds it on.
Yeah.
And then you do your tax calculations based on that.
Yep.
So whether you're 20%, 40% on all that, put it in, fine. That comes out with a tax bill. And then however much you pay in mortgage interest, you deduct 20%. So for people who are basic rate taxpayers, see no change to their tax returns with this new rule. I say new rule, it's about 5-6 years old.
Okay.
Right. But some people are still, that I speak to, new clients are going, oh, I didn't realize that. Yeah. So the accountants has obviously just been banging on, doing it right, but just not telling them that's why the tax bill's gone up.
Got you.
But so that you've got that. And then whereas like we talked about limited company, you get to the same position, you get to your rental profit, the same as individual, but then you take off your mortgage interest And then that's the profit that you pay 25% on in a company.
Right.
Yeah.
Yes.
But so typically, if you're a higher rate taxpayer, you're going to pay more income tax in the today tax year as an individual than you will as a limited company.
So that one is a tick in the box of company.
Yeah. And then it works out how much, because if you've paid more mortgage interest, then that becomes your tax bill might be less, but you might have paid out more for your mortgage.
Yeah.
Your product fee might be higher or something, whatever. And those start coming into the things when you're running. Essentially, the only way to do it, if you're trying to base it purely on numbers, is you go, right, scenario one is you buy yourself. This is the cost, this, all the way down to the bottom.
Yeah.
Scenario two is a limited company. Right. So that's the rental income I'll get. This is the mortgage interest. That's the tax bill. That's what's left over. Which one's looking better?
Okay. And you guys help.
Yeah, we can go through with that. Yeah.
Does that need to be after a mortgage offer or at least an indication?
You would go to your broker and get an indication of costs, because at that point you don't know whether you're putting in a limited company or not. So you need some hypotheticals.
Do they do that? Would they provide hypotheticals?
I would have thought so. They could give you some examples, some sort of figure, because you can always get a mortgage in principle deal for yourself. And so I don't think it's any different for a limited company, whether it's been formed or not.
Okay.
But again, that's what's the idea of speaking with them and talking to them, tell them what you're up to so they can understand your situation.
I'm still recovering from stress from buying our own house, so scares the hell out of me. Okay, so basically stamp duty 0 between personal and through a company. Mortgage interest or tax on a mortgage interest is 1-0 to company.
Yes, because it's cheaper. Yeah.
Okay. Now I might go off on around a little bit. How do the income and profits, you might have already told me this to be fair, from rental properties get taxed in the company, and how does this compare? I think that is what you've just told me.
So that's your 25%.
Yeah.
Yeah. So again, if you're a basic rate taxpayer individually, that's where they'll be better off, because they'll only be paying 20% tax on the profit, whereas a limited company would be 25.
Okay.
So again, that's where then we'll start going into reviewing your personal income when we're looking at it to go, are you higher rate? Are you likely to be a higher rate for how many years? Are you higher rate now for a year? But actually in 2 years time, you're going to start winding down and you'll become basic rate. So you'll have a tax. And it's all these things. No one person that we'll go through will be in the same situation with the same timescales and everything. And which is again why it comes back to that 20 questions. And I joke with clients, they go, oh, should I buy it in a limited company or not? I was like, let me get my questions out then. Let's go through them.
Yeah.
Because it's going to be different. And also it's also trying to predict that future of what you're like to do.
Change.
Yeah. So there's nothing stopping, the tax rules changing again in a company, but you've already got it in there. And like we talked about, you can't take it out easily.
No.
So it's one that you have to make the best judgment with everything you've got in front of you now. But there's a good chance it could change. Like a load of people who bought them didn't know that the interest rate was going to change, or the tax on interest rate was changing as an individual. So if someone that didn't know that 2 years before, they might have gone, oh, if I knew that, I would have put it in a limited company.
Yeah.
There's nothing you can do. They're just the unfortunate few that get caught and picked up by it.
Yeah. You can't predict the future on things like that. I mean, again, I'm not going to go down this rabbit hole, but that people are screaming out going, stop making people providing rental properties so difficult, because there isn't sufficient rental properties out there.
Yeah. And you'll get people, you'll scream and shout from both sides of the argument. You go, oh, they're mopping up the lower end, typically the lower end of the market that people would be first time buyers.
That's a good point.
So they can't get on the ladder. So therefore landlords are bad. However, also there's a load of people that can't even afford to get on the ladder because they can't get the deposits, that need somewhere to live. So therefore need to rent. So if the renters aren't there, then they got nowhere to live. So you could sit down and go, I could argue 6 for, 6 against.
Exactly. And it's not easy, is it? And
with anything, it's a balance. You need a mix of everything, because I got a friend, he's never owned a house. He's 38 now, and he's just moved around because he likes to move around the UK. He'll live in somewhere for 2 or 3 years, do work. He's got a remote job, and then he'll go move somewhere else for a bit and just go and move around. So if he lived in a place and kept buying his own house, he would be paying out thousands in stamp duty, which would be way more than the benefit you'd be getting of the house price going up.
It just wouldn't work with solicitors' fees and all this.
Yeah, that's it. And the time, and then you got to try and find someone like it to sell it. So if you go, oh no, actually I'm going to go up there in 6 weeks' time. Oh, I can't find anyone to buy my house. So he likes the fact that he can rent. Yeah. And you can just go get a flat or a house or whatever. So it's remembering there's always another side.
There is.
Appreciate there's a lot of people that do mop up the market on the rentals, and
especially in, like, say, Cornwall and places
like that. They mop up a massive amount of the market. So it's just seeing it, being having your eyes open and looking at both sides.
Well, so we said stamp duty was a draw. I think interest rate charge is probably 1 point to personal, because we said it's a little bit higher through a company.
Yep.
It's almost like half a point to it, because it was not a massive difference.
No, it depends how big your mortgage is.
True. Yeah. Okay. But tax of the interest rate is better for the company. So we're kind of at a draw to some extent now. Let's call it 1-1. Which means the final big topic area to touch on is exit capital gains tax. So when you decide you're going to sell that property on, what's the difference in capital gains implications between company and personal? So
individually, so when you sell a property, say you sell this example, we had £300,000, we sell it for £350,000.
Yep.
Okay. So you'll take individually, you take the sale price, less the selling cost. So estate agent fees, legal fees for selling, less the purchase cost of the property. So 300,000, less the purchase, associated costs, stamp duty, legal fees on buying, right? So you get then to a profit. So let's say that profit was 20 grand.
Yep.
Okay. If that's in your own name, you take off your tax-free allowance for capital gains, which is your annual exemption amount, which is now only £3,000. Used to be 12,300 quid. Okay. So you get your 20 grand profit, take off your 3. Okay. You got £17,000 that's taxable gain. Now, depending whether you're higher rate or not, you'll be paying 24% tax on that if you're higher rate.
Okay.
Okay.
Yeah.
So you pay that within 60 days. You do a separate capital gains return, and then it goes on your tax return. Right.
Okay.
Fairly simple. Okay. Limited company, similar basis. Okay. Same process of working out what the gain is.
Yep.
Charge it at 25% corporation tax for capital gains. Okay.
Okay.
However, it's the next bit. The money's still in the company. It's not in your own hands. Whereas as an individual, once you paid your capital gains tax, it's in your own hands.
Yeah.
You've got that money. It's been taxed. It's all in your pocket, go down the pub, spend it.
Yeah, yeah.
Over here, it's in a limited company. You then have to pay tax to take it out. Now, you might pay, depending on how much it is, you might pay, dividend tax. Okay. So that could be, if you're basic rate taxpayer, 8.75%.
Yep.
So you're at 25, we had 24. Now we got an 8.75 tax coming out of the company. All right. If you got a big gain, right, you might not want that as income tax, because that might put you at 33.75%.
Right.
Because of higher rate dividend tax. So then you might go, actually, I need to liquidate the company. So you've got to then pay somebody to liquidate the company to get a capital distribution at 24%. You check that one. But it's that sort of thing. So you've got, in this company, you're getting this double tax. Now, we talked about this sort of double tax thing at the start with if you need to live off the rental income, because you pay your corporation tax and then you're paying your dividend tax to take it out. And it's the same thing with once you sell it, because you've got a company, the money's in there that you've made off of selling it. So again, if it comes down to you're going to only have it for 2, 3, 4 years, maybe, you want this individually so you don't get caught by this double tax.
Yeah.
Right. And again, this is what comes into it, is the longevity of the investment. Is it something that you're going to have for forever? You're not looking to sell. Therefore, that would maybe make it a bit easier to be in a limited company if the other factors were good, because you're not selling it. So you can't compare these two. But if you go, no, actually, I'm going to do this for 3 or 4 years. Say you're buying, you're buying a house up for your son's university, and you're renting out to all his mates, and he's paying you rent. Yeah. Right? They're all paying rent, all market rate rent, and then he moves on, and then you go, right, brilliant. He's done that. I'm going to sell it, right? Yeah. You'll probably be back over here as an individual buying it rather than a limited company, so you don't pay the double stamp duty, double tax on it. Yeah. So again, it's another thing. Get your crystal ball out. What are you looking at? What's the lifestyle of the longevity of this investment? Okay. Yeah, which does seem challenging, because I can very much see people. Yours is a great example, actually, of like, my child's going to university. I'm going to get a house and they're renting back, and then they suddenly go, oh, actually, this is quite good. I'm going to do more. Yeah. Oh, I'm going to get a whole load of student loans because this will work really well. Yeah. And then suddenly but as you said, just leave that one as is from now on. The rest. And then you add the others on. Yeah. Okay. And so it's being just on like forward thinking as much as you can with these ones to see what the scenario looks like. Although being a motor racing commentator, I'm loving that split strategy idea. That bit of this, bit of that. Yeah, exactly. You're covering all options then. Okay. So which way did we end up going with that one then? Was that one to personal? Depends on how long. How long it is. So you can't, so with any of this, you won't get to a point where we'll go, it's definitely one or the other. Right. No. So there's one thing that, sort of as we're going through, I've thought of that actually is becoming incredibly important nowadays, which I think I'm going to take it down this route, even though it's not on your notes. And it's fine. You're dangerous like that, so it's fine. keep you on your toes, you see. And it's a phrase that's used more and more popularity of a family investment company. All right. So it's where you've got mum and dad who perhaps has got the wealth. Yeah. And is forward looking into inheritance tax planning or future sort of passing the money down the family tree. And it's a way that we can work with setting up a company in a certain way so that, mum and dad's wealth is used for the children, but the mum and dad still get a return of income in the short term, so that they don't give away everything, but they still get a return, but they're not getting caught up with inheritance tax with gifts and stuff. Yeah. And it's something that the last 6-7 months, it's been a bit more of a topic of conversation because as recent as that. Yeah, because of the inheritance tax changes. So we've had financial advisors working with us saying these clients need to look at something. And myself and Rob are looking at these opportunities in a way that we can help those clients build a future for their children. Okay. Wow. Okay. And obviously that ties in really well with what our model at Optimum is, because we've got Ian who can buy, if it's to buy some rental properties and bits, Ian can do the conveyancing for us. Yeah. We can do the tax planning. We can set up the company, so we can do the whole structure in here, especially when the only way we can't do all of it is if they want to get a mortgage on one of those properties, say they're buying. Yep. Because that's then the bring in for a mortgage broker, however, right? But if it was a cash purchase, we can deal with all of it, deal like the whole maintenance of it all, set up the structure, have the meetings, properly gun into where the income streams are, what you need, and go through these questions in depth. And we've been able to set up quite a lot of situations that really help parents pass that wealth down to the children in a tax efficient way. Fine, which makes sense. And I mean, just to clear up, obviously we spoke to Ian, I think it was a couple of episodes ago, about conveyancing and the like. I think it was, what is conveyancing? Because it's one of those misunderstood. I know the name, but I couldn't tell you and that was a good one on that. But even if you're saying a mortgage broker comes in, it's like, yes, you still do the majority of it, but there is another party involved. Yeah, they've lined up the person who's going to drop the extra money into the client account and able to purchase. So, and we work with many, many mortgage brokers, so we have a good relationship with them, and essentially the client can get looked after. So yeah, that's something that we're doing quite a lot with. Are we in a position then to say that my question, what are the main pros of buying through a company Mm-hmm.
And what are the potential drawbacks and complications? I think we've been doing it, but are you succinctly able to?
No, so naturally, I think if someone's trying to build a portfolio and grow it and to have it forever, a limited company would be a better route.
What do you mean by forever?
As in, they're going to build up a portfolio and they're going to pass it down to the children.
Right.
Okay. So that I don't foresee selling these properties. Right. Though that sort of scenario is one that would push down the limited company route in my eyes.
So that is presumably, as in they are saying, our mechanism for making money is from rentals coming in every month, and we're growing our portfolio, so we've got more rentals.
Yes. So they're not going to they're not going to take the money out for the rental income and put on their shopping bill, pay their shopping with.
Yes.
It's in this company. It's in a box. They're going to grow it, going to build it.
I meant as opposed to people that were taking on property with the intention to make money from the sell.
Yeah, a quick flip or something, or like a year flip, 18-month flip, and then a tax return, like doing the living off the rental income as well. Yeah. So I used to say to clients, you used to be able to get a short-term win with buying rental properties where you made money on the rental and then you made money on the capital value going up.
Yeah.
Nowadays, with all these extra costs and stuff coming in, so one thing, like you got the higher tax charges an individual, but if you go to a limited company, you got the lower tax charge, but you've got accountancy fees for doing a limited company, right?
Course,
so again, it's another thing. So you're not getting a lot of them a short-term win. So you're not going to go get a rental property and see your personal bank balance go up by very much in the short term. However, the hope then is that the value that's going to go up is better than leaving it in the bank account.
Yes, of course.
So it's taking all that into consideration.
Okay. Potential drawbacks and complications, I think.
So a limited company, with the idea of this family investment company, you can't just go, right, brilliant, I'm going to give my son 10% of these houses on shares. Because shares are really easy to transfer, one piece of paper and transfer it.
Yeah.
Drawback is you might be creating a tax charge, capital gain, even though you've received no money.
Really?
Because capital gains is done at market rate, not on consideration value.
Oh.
So again, that's another thing to be considering when we set up these family investment companies. It's good because you can give your son or daughter 10% of your portfolio as long as you're prepared you get a tax bill. It's a bit harder to give 10% of a property down than split the title 10% in that way. So it's easier in there, but you got the pitfall. Is that hidden, those capital gains tax charges that might happen. But that's the same as, if you were to do it individually and try and split it up, you're still giving away 10%.
Yeah.
You still got a capital gains tax bill.
Exactly.
So it is, there is just so many things to consider. And it is, but we do this all the time. We do these questions. We do these scenarios. Like I said, that email that I wrote that is 3 times nearly. Slightly different.
It's a lot, doesn't it?
In a space of a week or two.
Yeah, which does speak volumes that is the case.
And people are considering it. And it's, so the way typically I find is that those trades that we work a lot with, they like to be able to control their own money. They're in business to control their own things. So therefore putting money into a pension fund to go to whoever to invest in stocks and shares doesn't sit with them as a characteristic, because the whole reason they set up their own company was to control their lives.
Yep.
So therefore, those are the people that you typically see buying a rental property, because they can go, I can touch that, I can see that, I know it exists.
Yeah.
I drive by it on the way to, like, that customer that I'm doing an extension on, I can see my rental property. Yeah. You're just getting a piece of paper for stocks and shares. So when you look at trying to matching up those personalities, that's what a lot of them will do, because they can touch and feel it. They can see that rental property. They understand it, because if it needs some work, they can refix it. They can build it. They can add to it. They can do something with it, because that's their area. And that's why this comes up a lot.
Before I wrap this into a sort of a conclusion,
good luck.
is there anything we haven't covered that you think we should?
Yeah, probably.
I mean, and I guess that's almost a point in itself, is that there is a lot. I mean, I've got a phrase here: it's not a one-size-fits-all answer.
Absolutely not. No, each scenario will run through. We might come out with the same answer, but it'll be for different reasons that weighted it one way or another. I always say the needle. Which way does the needle go? It might still end up a limited company, or it might still end up in your own names. However, the reason why will be different nearly on every client.
Okay. And so if someone wants tailored advice from you guys to have a look at this, would they be able to do it at the exploratory stage?
Yeah. So like quite often, especially for existing clients, we'll have that conversation. We'll talk through, these are the things you need to be considering.
Yeah.
Because some of them are going, I think I might want to do this. What do I need to know? And so you go through these, like a lot of these points. These are the bits you need to know. And then if they go, right, actually I want some help to really work out which one is right for me, then we go down, we get a meeting, we gather up that information.
And tell them what they need to
and then we'll do
out.
a little report or an email that kind of gives the depth of going, this is the way that it looks based on your circumstances that you want to go.
Yeah. Okay. So how, and presumably it can be, you mentioned existing clients, but of course, people that aren't yet can become clients by coming and having to speak to you guys and get this tailored advice. Yeah,
that's it. So again, we'll have a first conversation or so for to start with, understand what it is they're after, and then we can provide quotes of what we would expect based on that that information. This is what it'll cost to go down this route. These are the services we can provide within it.
Yep.
These are the extra ones that we aren't included, but we can provide if it's something they want. Because some people have their own solicitors if they're going down the route and wanting to buy them.
Good
so that's fine. They've already got a strong relationship with them. We work with other solicitors as well because naturally they've got that. But to letting them know that we've got Ian on the conveyancing side as well. And we can just do it all here and keep it all together.
We've got the website there, OPTPS as in Optimum Professional Services.co.uk. So optps.co.uk. But is there anyone in particular they should reach out to?
No, just come into it, either, info at OPTPS or myself or Rob. And just contact us and we'll have that chat through and we'll see what we can come up with.
Fabulous. That's
Happy to help them.
That's the trick. Reach out, ask the questions.
Yep.
Even if to start with, you've got more questions that then means I know.
Oh yeah, definitely. That starting bit, I'm going to ask you more questions than you ask me.
Which is fine because I don't know what I don't know is the key point. So for you to go, right, I need you to go and find these bits out. Then I go, okay, cool, no problem. I'll go and find those out, then bring that back and then you assimilate that.
Yeah.
To then work out the right way to go.
Absolutely.
Brilliant. I've got a headache now, if I'm honest.
Yeah. Watch it back a couple of times. It makes sense then.
We will, yeah. Poor Tom's got to have a look through this and create the clips and everything from this. So he's going to have a headache as well. But Mike, absolutely brilliant. Thank you very much for that.
Thank you for hosting us again.
No, absolutely brilliant. So I hope that was useful for everybody. And if you've not got a headache, but in all seriousness, reach out. If it's something you're even thinking to do, you're doing, or you're going to change the way you do it, reach out to Optimum and you can see that there's a whole lot of consideration, certainly a lot more than I realised, to be fair. We'll then see you for episode 19, which I think is going to be coming quick far after.
Yeah, just about the verification for you for directors and essentially shareholders at Companies House.
Yeah, because people are suddenly getting contacted saying we need you to do this.
Yeah, we need to do the details. So it's the next bit to make sure that everyone is who they say they are on Companies House.
Okay, so we will look to cover that.
Yep.
Possibly within the next week or two so that we can get that information out to you as well. So we look forward to seeing you then. Cheers.
Cheers.